Oracle just dropped its latest earnings report. And on the surface, wow, it looks absolutely perfect. But you know the headline numbers rarely tell the whole story. So today, we're going to peel back the layers and uncover what's really going on. A massive, company-defining gamble that's been hiding in plain sight. Okay, first up, the number that got everyone buzzing. A 22% jump in total revenue. Now, why is this such a big deal? Well, get this. It's the first time in 15 years that Oracle has managed to grow both its revenue and its adjusted earnings by over 20%. For a tech giant of their age, that's practically unheard of. It's a huge achievement. And what's fueling this fire? It's their cloud infrastructure business, OCI, which just exploded by an incredible 84%, all thanks to AI demand. I mean, that's the story the market is desperate to believe in, right? But that's where our analysis really begins, with one simple question. How real is the profit that's coming along for the ride? All right, let's dive right in. First stop, the income statement. We need to figure out the actual quality of this growth. Is the profit really as solid as the revenue looks? And right away, we find our first clue. See, the market went wild for the adjusted or non-GAAP earnings number, $1.79 a share. But the official, audited GAAP number? It's way lower, at just $1.27. And that gap is mostly because they exclude things like stock-based pay for their employees. So what does that really mean? It means the true bottom-line profitability is a whole lot weaker than that flashy headline number would have you believe. But honestly, that adjusted profit, it's not even the biggest part of the story. Let's head over to the balance sheet, because the real risk, what one analyst is calling a hidden bomb, is lurking just out of sight. And here's the crazy part. This risk isn't even fully on the balance sheet itself. No, to find it, you have to go digging deep into the footnotes. And believe me, this one detail completely changes how you have to look at the company's risk profile. Just look at this number, $261 billion. Just let that sink in for a second. What on earth could that possibly be? Well, this is the hidden liability, $261 billion in what are called off-balance sheet lease commitments. Basically, these are ironclad contracts for all the data centers Oracle has to build to serve its new AI clients. And to give you a sense of scale here, this obligation has grown by nearly, wait for it, 25,000% in just 5 years. It's just staggering. And hey, don't just take my word for it. This isn't just our take. Analysts over at credit sites straight up called this a heavy bomb disclosure. It's a gigantic future liability that the market is really only just starting to wake up to. So, okay, if the profits are kind of fuzzy and the balance sheet is hiding a bomb, where do we find the real unvarnished truth? We've got to turn to the cash flow statement. This is the one place where the numbers simply can't hide. This chart right here, it tells you everything you need to know. Over the past year, Oracle's operations brought in a pretty respectable $23.5 billion in cash. But now look to the right. The company is planning to spend around $50 billion on capital expenditures this year alone. Let me say that again. They are planning to spend more than double the cash their entire business generates. And all that spending has led to a jaw-dropping cash burn. Just in the last 3 quarters, Oracle's free cash flow is negative $44 billion. Let's be perfectly clear about this. This amazing growth we're seeing, it's not being paid for by profits, not even close. It's being funded by taking on mountains and mountains of new debt. So when you put all the pieces together, the weak quality of the earnings, those massive hidden liabilities, and the absolutely insane cash burn, one single very clear picture starts to form. What we are watching right now is Oracle making the gamble of the century. What's happening is a fundamental transformation. Oracle is literally shedding its old skin as a software company and trying to become something new, an AI infrastructure landlord. It's shifting to a heavy asset business model, building and leasing out compute power on a colossal scale. This is a complete bet-the-company pivot, all in an effort to survive in this new age of AI. And you have to ask, why would they take such a mind-boggling risk? Well, the simple answer is they feel like they have to. Just look at who they're up against. We're talking about giants like Microsoft, Amazon, and Google, titans with way deeper pockets. So in their mind, going all in, building out their own infrastructure, it's the only path forward. It's the only way to stay relevant. And this right here, this slide, it captures the whole dilemma for any investor looking at Oracle. On one side, you have the promise, a truly incredible $553 billion in contracted future revenue already on the books. But on the other side, you have the cost. A $44 billion cash burn just to get here, backed by that hidden $261 billion in future commitments. The potential upside is absolutely immense, but the risk, well, it's existential. And that brings us to the final, all-important question. Is this life or death gamble Oracle's ticket to the future of AI computing? Or is it just another ticket for the Titanic? The numbers, as we've seen, point to both a potentially spectacular future and a absolutely terrifying risk. And honestly, only time is going to tell which way this extraordinary bet breaks.